Welcome to KonceptCraft. Introducing the Accounting Arena book, your ultimate guide to mastering the fundamentals of accounting. Embrace the world of accounting knowledge at your fingertips. Act now, and get your copy of Accounting Arena ebook. Link is available in the description below. Keep learning. Keep growing. Happy learning. Now let's begin our today's lesson.
Inventory and cost of goods sold. Inventory and cost of goods sold are two important concepts in accounting. Inventory refers to the goods that a business has on hand for sale or use in production. Cost of goods sold, COGS, is the expense that a business incurs to acquire or produce the goods that it sells. COGS is calculated by subtracting the ending inventory from the beginning inventory plus purchases during the period. COGS affects both the income statement and the balance sheet of a business. A higher COGS means a lower gross profit and net income, but also a lower asset value for inventory. A lower COGS means a higher gross profit and net income, but also a higher asset value for inventory. Therefore, inventory and COGS have an inverse relationship and a significant impact on the financial performance and position of a business. Inventory and cost of goods sold, COGS, are two important concepts in accounting that are closely related to each other. Let's discuss each term separately. Inventory. Inventory refers to the goods or products that a company holds for sale in the ordinary course of business. It includes raw materials, work in progress, partially completed goods, and finished goods. Inventory can be categorized into different types, such as raw materials inventory, work in progress inventory, and finished goods inventory, depending on the stage of production. Inventory is recorded as an asset on the balance sheet until it is sold. It represents the cost of acquiring or producing the goods that are intended for sale. The value of inventory is typically determined using either the cost method, example, first in, first out FIFO, last in, first out LIFO, or average cost, or the lower of cost or market value method. Cost of goods sold, COGS. The cost of goods sold, COGS, is an expense incurred by a company to produce or acquire the goods sold during a specific accounting period. It includes the direct costs associated with the production or acquisition of the goods, such as the cost of raw materials, direct labor, and direct overhead costs. COGS does not include indirect costs like administrative expenses or selling and marketing expenses. COGS is an important figure used in calculating the gross profit of a company. It is subtracted from the net sales revenue to determine the gross profit. The formula to calculate COGS is as follows. COGS equals opening inventory plus purchases, or cost of production, closing inventory. The opening inventory represents the value of inventory at the beginning of the accounting period. The purchases, or cost of production, represents the cost of additional inventory acquired or produced during the period, and the closing inventory represents the value of inventory remaining at the end of the accounting period. By subtracting the COGS from the net sales, a company can determine its gross profit margin, which indicates the profitability of the core operations. It's important to note that different accounting methods, example, FIFO, LIFO, or average cost, can lead to variations in the calculation of COGS and the resulting financial statements. The specific method chosen can impact the reported COGS, profitability, and taxes paid by the company.